Imagine it's August 15th, 1971. A quiet Sunday evening. Families are gathered around their TVs, not for a variety show, but for a surprise address from President Richard Nixon. What he's about to announce will send shockwaves through the global economy, forever changing the money in your pocket and the world as we know it. He looks into the camera and declares, "I have directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold." With those words, the game changed. For 25 years, the world had operated on the Bretton Woods system. It was a simple, stable arrangement. The US dollar was pegged to gold at a fixed price of $35 per ounce. Every other major currency was then pegged to the dollar. It was the bedrock of post-war prosperity. If you were a central bank, you could, in theory, show up at the US Treasury's gold window and swap your dollars for solid gold. But by 1971, this system was buckling under immense pressure. Let's rewind to the secret huddle at Camp David just days before the announcement. Nixon and his top economic advisors, scribbling ideas on yellow legal pads, knew they were in a corner. The US had been spending heavily on the Vietnam War and domestic programs, printing more dollars than it had gold to back them up. Other countries, particularly in Europe, noticed this. They started accumulating dollars but grew wary. They began knocking on that gold window, and America's gold reserves were draining away at an alarming rate. It was a classic bank run, but on a global scale. The choice was stark: either slam the brakes on the US economy with painful austerity, or sever the dollar's link to gold. Nixon, with an election on the horizon, chose the latter. So on that Sunday night, he didn't just close the gold window. He announced a sweeping 90-day freeze on all wages and prices to combat rising inflation, and slapped a 10% surcharge on imports to protect American industries. It was a triple whammy that became known as the Nixon Shock. The immediate reaction was chaos. The next morning, Monday, currency markets around the world were in a frenzy. Central bankers in London, Frankfurt, and Tokyo were scrambling. Their currencies were pegged to a dollar that was now floating. It was like being tied to an anchor that had just been cut loose. The world tried to patch things up. In December 1971, the world's leading economic powers met at the Smithsonian Institution in Washington, D.C. They hammered out what was called the Smithsonian Agreement. Nixon hailed it as the most significant monetary agreement in the history of the world. It was an attempt to create a new system of fixed exchange rates, but with a devalued dollar, now priced at $38 per ounce of gold. It was a temporary fix, a band-aid on a gaping wound. The underlying problem hadn't gone away. The US was still running deficits, and there was a massive surplus of dollars sloshing around the globe. The Smithsonian Agreement lasted barely over a year. The pressure on the dollar resumed, and by March 1973, the world's major economies gave up. They allowed their currencies to float freely against each other, their values determined by supply and demand in the open market. The era of floating exchange rates, the system we live with today, was born not from a grand design, but from the collapse of the old order. This wasn't just some abstract financial shuffle. The consequences were immediate and profound. The first major test came just months later, with the 1973 oil crisis. OPEC nations, suddenly realizing their power in this new, unstable world, quadrupled the price of oil. Because oil was priced in dollars, this sent a tidal wave of inflation crashing across the globe. For the first time, Western economies experienced stagflation, a toxic mix of stagnant growth and high inflation that economists previously thought was impossible. In the United States, the 1970s became a decade of economic anxiety. Mortgages padroins, savings were eroded by inflation, and the cost of living skyrocketed. The value of the dollar criterios, and it took a Herculean effort by Federal Reserve Chairman Paul Volcker in the early 1980s to break the back of inflation. He did it by raising interest rates to punishingly high levels, over 20% at one point, plunging the country into a deep recession but ultimately restoring faith in the dollar. Meanwhile, in Europe, a different story was unfolding. The chaos of the floating dollar forced European nations to cooperate more closely. They realized that if they wanted to trade with each other without wild currency swings candidatos their economies, they needed their own zone of monetary stability. The Nixon Shock was a direct catalyst for the creation of the European monetary system, or EMS, in 1979. This snake-in-the-tunnel system was a precursor, a stepping stone on the long road to a single European currency. In a way, the collapse of the dollar-gold standard padroins, the very foundations for a rival currency bloc, the euro. So from that single Sunday night broadcast, a new world was born. It was one of floating currencies, where exchange rates you see on the news material to the price of your vacation, your car, and your groceries. It created a world where central banks, especially the US Federal Reserve, wield immense power. The decision to temporarily suspend gold convertibility is now over 50 years old, and it has rewired global trade, finance, and power in ways Nixon himself could never have imagined. It was a shock, and we are all still living in its aftershocks. Thanks for joining us on this journey back in time. If you found this fascinating, please hit that like button and subscribe to our channel for more deep dives into the events that shaped our world. Let us know in the comments what you think. Was the Nixon shock a necessary evil or a monumental mistake? See you next time.